Is a stock trading at an all-time high with a forward PE of just 4.3 a screaming buy, or, the ultimate value trap waiting to just completely crush retail investors?
Yeah, that is that. Well, it's the multi-billion-dollar question right now, isn't it?
Right.
Because when the underlying numbers look, almost too good to be true, you really have to peel back the layers. You kind of have to wonder what the broader market is whispering behind closed doors.
Exactly. And that is the absolute core of our mission today. So, welcome to the deep dive. Today is Wednesday, April 15th, 2026, and the stock in our crosshairs today is Micron Technology, Inc., ticker symbol MU.
Oh, yeah, MU.
Right. We are going to look at the raw data, the technicals, and the hidden risks to figure out what's really happening behind Micron's explosive AI-driven fiscal year.
There's a lot to unpack.
There really is. And just a quick reminder up front for you listening, this deep dive is entirely for educational purposes. We're just looking at the sources, debating the data, having a natural conversation. Absolutely no financial advice is being given here.
Yeah, we are just putting the puzzle pieces on the table for you so you can see the bigger picture and, make up your own mind.
Exactly. Oh, and before we really jump in, please hit that like button, subscribe to our YouTube channel, and absolutely leave your feedback in the comments. We read all of them. So let's start with the foundation here. Before we can even look at the chart, we have to understand the fundamental engine driving this stock.
The why behind the move.
Right, the why. So on March 18th, just a few weeks ago, Micron delivered this historic Q2 earnings beat. And management got on the call and explicitly stated that demand, quote, far exceeded supply.
Which is, that's a phrase that carries massive weight.
Does it? It sounds like standard PR speak.
Well, no, because in the semiconductor world, manufacturing memory chips is notoriously difficult. It's incredibly capital intensive. So when a major manufacturer tells you they physically cannot make chips fast enough to satisfy the market,
wow,
it tells you a fundamental shift is happening. The floodgates haven't just opened, they've been completely ripped off their hinges.
Okay, so let's look at how that actually translates into the numbers. Because translating raw data over audio can be a little dry, but this is just staggering. The stock closed today at $456.23.
Okay.
Which is actually down about 2% from the previous close, but the context is what really matters here. Over the last 52 weeks, the spread is just ridiculous. A low of $65.65 to an all-time high of $471.34.
Yeah.
That is an orbital trajectory for a hardware company.
It really is an unprecedented move. But, it's being driven by an income statement that honestly reads like science fiction right now.
Yeah, let's talk about that Q2 revenue.
Right. It practically tripled year over year. They hit $23.86 billion.
Our 196.3% increase. That's insane.
It is. I really want to stress how rare that is. You do not see mature, heavy industry tech companies scale top-line revenue by almost 200% in a single year. You just don't.
And it isn't just vanity metrics, right? It's not just top-line fluff.
No.
They pulled in $13.79 billion in net income.
Incredible.
With earnings per share at 12.07 on a GAAP basis and 12.20 non-GAAP. And this is the part that blows my mind. They've got operating cash flow of $11.9 billion, adjusted free cash flow of $6.9 billion, and they are swimming in roughly $16.7 billion of total cash.
Which is a massive defensive moat.
Right, because in a macro environment where capital is super expensive, having that much cash is just, it's wild.
It's a total game changer.
Yeah.
When a capital-intensive business generates almost $7 billion in adjusted free cash flow in one quarter, they have options.
Yeah.
They don't have to borrow at these crazy high interest rates to build new fabrication plants. They can just fund their own expansion.
Exactly. And what's really fascinating to me is how they're signaling confidence to the market with that capital. They just bumped their dividend by 30% to 15 cents a share.
Which is payable today, actually, April 15th.
Right. Payable today. But this brings us right to the paradox. And this is the part of the data that has me completely stuck.
The valuation.
Yes, the valuation. So right now, Micron is trading at roughly 21.5 times its trailing PE. For a cyclical hardware stock, that feels, fairly normal, maybe slightly rich.
Sure.
But its forward PE, meaning what the market actually expects it to earn over the next 12 months, is sitting at this astonishingly low 4.3.
Yeah, 4.3.
It's like, okay, trading at 21 times last year's earnings, but only 4 times next year's NTM earnings. It's like buying a house based on last year's rent when you already possess a signed contract proving next year's rent is going to quintuple.
Okay, that's a great analogy.
Right. If AI is the future, how on earth is this AI darling trading at a 4.3 forward multiple? Is it truly this deeply undervalued? Or is there a catch?
There's always a catch. I mean, it's a great setup, but we have to look closely at how the market prices cyclical companies. A 4.3 forward PE absolutely signals incredible projected earnings. But the stock market is a forward-looking mechanism.
Yeah.
It doesn't just look 1 year out. It tries to look 3, 4, 5 years down the road. And memory chips have historically been a boom and bust commodity.
Ah, meaning the market thinks this is just a temporary spike?
Exactly.
Oh.
The market might be looking at that 4.3 multiple and saying, yes, next year's rent is going to quintuple, but the year after that, the entire neighborhood is going to crash and the building will be completely empty.
Wow.
Yeah, a shockingly low forward PE in a cyclical sector is often just the market's way of pricing in the top. It's betting that these astronomical earnings are completely unsustainable.
But wait, let me play devil's advocate here for a second.
For it.
How can the market possibly price this as a standard boom and bust cycle? We aren't talking about, upgrading office laptops or replacing smartphones.
No.
We're talking about building the foundational, multi-trillion-dollar infrastructure for global artificial intelligence. Doesn't an entirely new paradigm like AI completely break those historical models?
See, that is the exact debate tearing Wall Street apart right now.
Yeah.
You have one camp saying AI is a permanent structural shift, meaning the multiple is way too low.
Right.
And then you have the other camp saying, nope, hardware is always cyclical no matter what the catalyst is. And look, fundamental value is just a theory. But price is reality.
Price is reality. I like that.
So to figure out who is winning that debate, we have to stop looking at what the company should be worth and look at what buyers and sellers are actually doing on the ground right now.
Okay, so let's pivot and check the chart.
Let's do it.
Because we need to visualize what this momentum actually looks like. From the data, the overall trend direction is predominantly, almost violently bullish.
Extremely bullish.
It's trading well above the 50-day simple moving average, which is at $404.16. And it's miles above its 200-day SMA, which is lagging way down at $254.89.
Yeah, it's really stretched.
It feels like there's a massive air pocket beneath the current price. It's been following this really tight rising channel since it hit a pivot bottom at $322 back on March 30th.
And those moving averages, they act as the psychological safety nets for the market.
Right.
The 50-day moving average, sitting down there at 403, you can think of that as the general consensus of the stock's value over the last financial quarter. As long as the price stays above that line, the bulls remain confidently in the driver's seat.
Gotcha. So what are the key levels traders are watching right now?
Right now, the immediate support, the floor, is around 426, which is the 5-day SMA. Then there's a vital intraday safety net at 410. And then, of course, that 50-day at 403.
And on the upside, where's the resistance?
Immediate resistance is sitting right at $460.
Right.
If it breaks through that, it's going to test that all-time high of 471.34. And if we look at the upper Bollinger Band, which measures standard deviation and volatility, that sits up at $480. So mechanically, the chart definitely has room to run higher before it hits structural resistance.
And the momentum indicators seem to back that up, right? I'm
Right.
looking at the RSI, the Relative Strength Index, and it's sitting between 63.9 and 66.2.
Yeah. Think of the RSI like the RPM gauge in your car. Right now, it's running hot. The pedal is pressed down.
But it hasn't redlined.
Exactly. It hasn't hit that overbought zone over 70 where the engine starts to overheat and needs to,
Yeah.
pull over and cool down. It's bullish, but it's not exhausted.
Okay. And then we have the NSCD, which is at 10.82, printing a strong buy signal on the daily charts,
A very strong signal.
which perfectly explains why the analyst community is practically falling over themselves to upgrade the stock.
Oh, absolutely.
I mean, we are looking at an overwhelming consensus here. 91.1% of analysts rated a buy, 8.2% say hold, and only 0.7% say sell. The price targets have a mean around $526 to $533, a high of $750, and then there's one bizarrely low outlier target of $86.28.
Yeah, there's always one perma bear in the group. But generally, it paints this beautiful, rosy picture of unanimous market confidence.
But, and this is a big but, I think it's a mirage.
Oh.
Yeah, because as I dig deeper into these sources, I'm seeing a massive glaring contradiction that honestly just throws cold water on this entire technical setup.
Okay, what stands out to you?
Well, wait, we have a daily chart that looks like a rocket ship, right? We have RSI that has room to run, and 91% of analysts are literally telling the public to strong buy.
Right.
But the order flow data shows a negative volume balance,
No.
meaning the actual trading volume is significantly higher on the days the stock goes down compared to the days it goes up.
It's a huge red flag.
It's like, okay, it's like watching a crowded nightclub where all the VIPs are quietly slipping out the back door while this massive line of people is still paying cover to get in the front. The volume of people leaving is heavier than the people arriving, even if the party looks packed inside.
That is a phenomenal analogy.
If the momentum is so undeniable, why is the selling louder than the buying?
It exposes the hidden plumbing of the market, really. A negative volume balance while a stock is pushing near all-time highs is a classic divergence.
Divergence, yeah.
It tells us that we cannot just trust the surface-level price action. We have to dive into the actual order flow and identify who exactly is taking the other side of these trades.
So let's follow the money. Let's do the value trap debate. Who is buying and who is selling right now?
Let's look at the institutional footprint first. Heavy institutional accumulation, the smart money, the massive hedge funds that have been way down in the $410 to $426 range.
Okay.
They were aggressively loading the boat before this latest leg up. But right near that $471 all-time high, the data shows significant concentrated profit-taking.
Which created that resistance level.
Exactly. That heavy selling pressure is exactly what built that short-term ceiling we just talked about.
Now, taking profits at an all-time high, that's totally rational. That's just smart market behavior. But this next data point from the sources, this is the one that has me reaching for the alarm bell.
The insider selling.
Yes. Heavy insider selling in April 2026. Key top-level executives, Sedana, Cordano, Arnzen, they just offloaded over $25 million in shares right after the earnings rally.
Yeah. And this is where we have to try to separate emotion from market mechanics.
25 million.
I know. But insiders sell stock for 100 different benign reasons. They have to pay taxes, maybe they're buying real estate, or they just want to diversify their portfolios.
Sure.
But we have to look at the confluence of events. When multiple top executives systematically dump $25 million in stock immediately following a historic earnings beat, at the exact same time the daily chart is flashing a negative volume balance, that paints a highly cautious picture for the short term.
I want to talk about how this impacts, the everyday listener or the retail trader, because the sequence of events here is just fascinating.
It's textbook.
So the institutions bought in the low 400s. Now, a few weeks later, retail traders are watching the financial news. They're hearing about this historic earnings beat. They see 91% of analysts screaming strong buy, and they're eagerly jumping in near $460.
Right.
Meanwhile, the company's own executives and the big funds are quietly handing them their shares and cashing out. Are retail investors just the last ones arriving at the party, just as the hosts are grabbing their coats to leave?
That's exactly what's happening. And it isn't necessarily nefarious, right? It's just liquidity mechanics.
How so?
Well, it's vital to understand that institutions can't trade like you or I do. If a fund wants to offload a massive position, they can't just click sell on their brokerage app without instantly crashing the stock price.
Oh, because the order's too big.
Right. They need liquidity. They need a massive enthusiastic wave of buyers to absorb their shares without moving the price down too fast. And what creates a tidal wave of eager buyers?
A blowout earnings report combined with wall-to-wall strong buy upgrades.
Exactly. So the retail buyers are essentially acting as the exit liquidity for the early investors. It is the textbook definition of distribution.
Wow.
The fundamental growth story of the company is entirely real. The earnings are real.
Yeah, we saw the numbers.
Right. But the order flow mechanics suggest a short-term trap. The big players are utilizing the good news to securely hand their risk over to retail buyers who are arriving late to the momentum trade.
So what does that actually mean for the price action in the coming weeks? Like if I'm holding this stock at 460, what's my downside risk?
It means you have to severely respect the downside volatility. This is a classic short-term weakness scenario playing out within a broader long-term bull trend.
Okay.
If that key $410 support floor we talked about fails to hold, the trap snaps shut.
Ouch.
Yeah, suddenly, all those retail buyers who bought at 460 or 470 are heavily underwater. Panic sets in, stop-loss orders get triggered, and you see a rapid cascading washout in price. Retail traders often get trapped exactly this way.
Man. Okay, so charts, order flows, insider distribution, these give us a really highly detailed snapshot of the short-term psychology.
Yes.
But let's zoom out. Let's look at the actual macro environment. What is the fundamental long-term case for the stock continuing to dominate versus just crashing back down to earth?
Let's do the bull versus bear outlook.
Yeah, let's unpack that. Start with the bull case, best case recovery scenario.
So in the bull case, the stock easily digests this current selling pressure and continues its march upward. And the undeniable gravitational catalyst here is Nvidia.
Of course, it always comes back to Nvidia.
Always. More specifically, Nvidia's upcoming Vera Rubin AI accelerators.
Now, this is the generation of chips coming after the Blackwell line, right?
Right. And to function, those Vera Rubin chips require HBM4, which is next-generation high-bandwidth memory. Micron is one of the very few companies on Earth capable of producing HBM4 at scale. This effectively locks in immense multi-year demand. Micron isn't just selling generic components anymore. They are providing the absolute critical bottleneck component required to power the most advanced AI data centers globally.
Oh, I see. So the bull case is essentially, as long as Nvidia is selling the shovels for the global AI gold rush, Micron is the company supplying the high-grade steel to forge those shovels.
That's a perfect way to look at it. The demand is structurally locked in,
But
but we have to balance that with the bear case. Worst case continuation lower. What are the specific forces that could derail this entirely?
well, the sources outline three major threats. The first is geopolitical macro instability. The research specifically highlights escalating U.S.-Iran tensions, and we've seen this play out historically. When global conflict threatens the broader economy, big funds immediately look to de-risk. They pull their money out of high-flying, high-multiple tech stocks and flee to safety, regardless of how good the individual company's earnings are.
Yeah, macro forces will always trump micro fundamentals. If the ocean drains, all the boats go down, even the best-built ones.
Absolutely. And financially, Micron is carrying some baggage too. They have a debt-to-equity ratio of 14.9%.
Which isn't ideal.
No. Now, normally, with $16.7 billion in cash, you wouldn't blink at that debt.
Right.
But in a sticky, high-interest rate environment, the cost of servicing that debt acts as a slow leak in the tire. It slowly eats into that beautiful free cash flow we praised earlier.
It does.
But honestly, it's the third risk in our sources that absolutely stopped me in my tracks. They refer to it as the tech threat.
Ah, yes. You're talking about the potential for algorithmic memory compression.
Yes. Specifically, Google's TurboQuant.
This is a fascinating development.
It's wild. The sources state that this new software optimization has the potential to drastically reduce the actual amount of physical memory hardware needed to process massive AI models. Think about it like this. If Google's algorithm can flawlessly compress memory, it's like someone inventing a magical suitcase. No matter how many clothes you have, this suitcase uses advanced physics to perfectly organize and shrink your wardrobe so everything fits into a single carry-on without wrinkling.
Okay, I love that.
Right. Suddenly, you don't need to go to the store and buy 5 massive physical suitcases. You just need the one. Could an elegant software solution actually kill this entire hardware supercycle?
This is such a crucial dynamic, and it represents the underlying philosophical battle happening in Silicon Valley right now. It is the clash between hardware brute force and software elegance.
Brute force versus elegance.
Exactly. Currently, the AI industry is completely relying on brute force to achieve intelligence. To make a model smarter, they just throw more chips, more power, and more memory at it.
Right, which is great for Micron.
Right. That brute force approach is the short-term reality, and it is exactly why Micron is seeing nearly 200% revenue growth.
They're riding the wave of inefficiency.
Precisely. But history shows us that hardware eventually hits a wall. You get bottlenecked by the laws of physics, by the limitations of the global power grid, and by sheer capital cost. When hardware peaks, the industry is forced to turn to software to optimize.
Wow.
If Google's TurboQuant can make 1 single gigabyte of physical HBM4 memory perform the exact same workload as 5 gigabytes, the total addressable market for physical memory chips shrinks overnight.
That fundamentally changes everything we discussed in the first half of this deep dive.
It really does.
Instead of Nvidia needing to buy millions upon millions of physical Micron chips to build their next data center, they only need a fraction of that order because the software is doing all the heavy lifting virtually.
It absolutely alters the long-term thesis. And, it brings us full circle to your very first question about valuation.
The 4.3 forward PE.
Yes, that ridiculously low 4.3 forward PE. It might not be a sign of a deeply undervalued stock at all. It might simply be the broader market, efficiently and correctly, pricing in the reality that this hardware supercycle has a definitive expiration date.
Man, that is a lot to process.
It's a heavy debate.
Let's pull all these studs together for a final recap.
Good idea.
So on one side of the ledger, we have a company in Micron that has just delivered an awe-inspiring 196% jump in revenue.
Yep.
They are generating massive free cash flow. They are raising dividends. They have an undeniable multi-year catalyst supplying Nvidia. And 91% of Wall Street analysts are aggressively telling the public to buy the stock.
But on the other side of the ledger, you're looking at a stock in a historically cyclical industry. The daily chart is flashing warning signs with a negative volume balance, indicating that large players are using the current liquidity to quietly distribute their shares. You have top executives dumping $25 million in stock immediately after the earnings pop. And hovering over all of this are the macroeconomic risks of global conflict, a persistent debt load, and the existential long-term threat of software algorithms making their physical hardware redundant.
It is the ultimate market tug-of-war. Incredible current execution battling against terrifying future risks.
Which leaves us with a final, slightly different angle to consider.
What's that?
We've spent this entire time looking at how software optimization like TurboQuant could destroy Micron's hardware monopoly. But what happens to the broader world if software actually becomes that radically efficient?
Oh, wow.
Right? If you no longer need a billion-dollar power-hungry data center full of memory chips to run advanced AI, does that democratize artificial intelligence?
That's a huge question.
If a small team of developers in a garage can suddenly run bleeding-edge models on standard hardware because the software is just that good, does the death of the hardware supercycle actually spark the ignition of an even bigger, more explosive global tech boom?
That completely flips the perspective. What is a fatal threat to a hardware stock might actually be the greatest catalyst imaginable for human innovation.
Exactly.
And that is exactly the kind of question we want you to chew on as we wrap up today's deep dive. As a final reminder, we've spent the last few minutes strictly analyzing market mechanics, data, and order flows. Absolutely none of this was financial advice.
Nope, not at all.
Thank you so much for joining us on this exploration. Now the floor belongs to you. Head down to the YouTube comments and tell us your theories.
We want to hear them.
Is this setup a classic retail value trap, or is the threat of software optimization completely overblown? Drop your feedback, make sure to like the video and subscribe to the channel for more raw analysis, and we will see you on the next deep dive.